Hi there, it's Professor Joe Omani from Consulting Mastered here. I'm just going to give you a couple of minutes about what buyers of consulting firms are looking for. You may or may not know that around 300 consulting firms are sold each month, typically with revenues of between $4 million to around $40 million dollars. In terms of what buyers are looking for, obviously this is part of a much bigger research project that I'm doing in terms of how to grow and sell consulting firms. I guess the first thing to say is that there's different types of buyers. Private equity were relatively unusual, but now because consultancies generate so much cash, now account for up to 50% of purchases. Depending on the economic cycle and the cost of debt. Obviously private equity firms borrow at a low cost and try and invest that money to create a bigger return. Private equity are obviously less interested in the type of consultancy that you're doing and more interested in whether it's going to generate revenues for you. The second type of buyer is the strategic buyer, which is typically a larger consulting firm, although not necessarily a management consulting firm. These people are typically looking for strategic alignment between themselves and the consultancy that they're buying. This is so typically that they can sell whatever product you've developed and have been selling to a small market and offer it to their own clients. So this is attractive to sellers as well, obviously, because they're now being able to sell to a much larger market if they're part of a strategic purchase. There's lots more I can talk about here, but I want to be relatively quick. So focusing on what buyers are looking for. The first is solid, and these are in order of importance. So solid, sustainable growth. The higher your growth rate, providing that you're relatively profitable, though they care more about growth than profits, the higher the growth rate, the higher ratio that you're likely to get in terms of your price. Profits, ideally buyers are looking for EBITDA of 20% margins or even greater. The firms that I've been interviewing and surveying range between 18% all the way up to 28%. Thirdly, revenues. Now different types of buyers are going to look for different size consultancies. But you're looking somewhere between 4 million as a minimum up to 40 million. Obviously, the bigger you get, the bigger payday you get. So the challenge here is that it's relatively easy. I'm not saying it's simple, but it's relatively easy to grow a firm to around $4 million, or £4 million. Simply by getting a load of people together. However, if you want to grow beyond that, then you need sort of management systems, processes, professional management, CRM systems, professional service automation systems, etc. So it's a different type of beast after the around the 5 million mark. So many people choose to sell at the smaller level. Fourthly, a niche differentiated offering. Obviously, buyers don't want to buy something that people can easily copy or where there's a lot of competition in the market. Part of your ability to protect that is around having intellectual property. Now, intellectual property per se isn't particularly protectable, but it does allow a brand and a package and a product to be associated with your offerings. So if you can have some form of intellectual property, and ideally they're looking for intellectual property that doesn't require people. So for example, software, video training, apps, systems, etc. But if you haven't got that, then they're happy to look at methods, processes, tools, etc. Buyers also see intellectual property not just in terms of the products and services that you're selling, but also in terms of your internal systems. For example, do you have a commodified system for selling that is particularly useful and puts you ahead of the competition, for example? So they will see intellectual property as any asset, any knowledge asset that you have that provides value to the firm. A long-term distributed client base, distributed meaning that typically they don't like seeing any one client having or being responsible for more than 20% of your revenue. I've spoken to several firms who were on that growth trajectory, and one client hit some rocks and they lost 50% of their revenue overnight, something that investors are very aware of. We're currently in the COVID situation. I've spoken to several sellers who are in the process of selling only for COVID to hit, and very often the fact that they didn't have a diversified portfolio meant that they were hit quite badly. Not necessarily their fault. I mean, COVID was hard to predict, certainly if you're a Tory government in the UK. And finally, a strong management team. Now, what you'll see with these things, that there's a good mix of quantitative and qualitative measures. They will go through your books, they will go through your finances, but they will also interview the management team and do a lot of qualitative analysis. And it depends on the buyer where their emphasis is. The strategic buyers tend to have more of a qualitative bias, and private equity tend to have more of a quantitative bias. In terms of what you're going to be getting for your bang, or bang for your buck, it's generally an increasing revenue based on your profit margins. The higher your profit margins, the higher your price multiple. So this, if you've got standard profit margins of 20%, you're looking of a price multiple of around, say, 8%. However, this can be scaled by all types of things, but specifically growth. If you're growing fast, then your price multiple will be higher. It will be moderated by your niche. I've interviewed and studied several firms in the artificial intelligence or automation or a big data space that are getting multiples of almost 30, but they're missing some of the things that I said were important to buyers here. So if you have a strong niche and experts, buyers will very often be forced to be softer with you on other criteria that they'll have. They will remain nameless, but I recently helped it was a few years ago, I helped a group of consultants who basically graduated from universities with very good artificial intelligence insights, got together, created a consultancy. Within 4 years were purchased. They didn't have strong systems, they didn't have a strong management team in terms of the typical competencies, but what they had were lots of bright, incredibly able people and clients just willing to throw money at them. Economic cycle, relatively obvious, and also branding and communication. You may have the best consultancy in the world, but unless you can communicate that to potential buyers, then you're going to be getting a much lower multiple. So investing in your branding and the communication of that branding and the communication of what you've achieved is really important. Okay, I hope that was useful. A lot of the things that I've talked about here, you might think, well, I don't want to sell my management consultancy, but all of these things are things that you should be thinking about if you're a small consultancy that wants to grow. Anyway, I mean, buyers want to buy good consultancies, and hopefully if you own or run a consultancy, you will want to have a good consultancy. So all of these things are at least things that you should be considering. Okay, hope that's useful. Any questions, drop me an email. Take care. Bye-bye.